Okay, let's get right into it. Today we are breaking down the Q2 2025 earnings from Utz Brands. And this is a fascinating one, folks. It's a classic Wall Street puzzle. A company reports what seems like great news on the surface, but the market's reaction is just brutal. So let's figure out what's going on. This is the number that got everyone talking. On July 31st, right after they dropped their earnings report, shares of Utz Brands just fell off a cliff, down 10.3%. I mean, that is a sharp, painful drop for anyone holding the stock. And that brings us to the big question we're going to solve in this explainer. How on earth does a stock collapse when the company actually beat revenue expectations? We're going to unpack the numbers and see exactly what Wall Street was looking at and maybe what they were missing. So it all starts with the headline numbers. And right away, you can see a pretty clear contradiction. This is exactly where all the confusion and, frankly, the sell-off really began. Here's the split personality of the report. On the one hand, you've got revenue coming in strong at $366.7 million, which was better than analysts were looking for. That's your top-line strength. But on the other hand, adjusted earnings per share, or EPS, landed at just 17 cents. That missed the consensus, which was closer to 19 cents. And that's the bottom-line weakness that spooked everybody. And this is where things get really interesting, because it shows their incredible operational strength. While the entire salty snack category actually shrank by 1.5%, Utz Brands grew its sales by over 3%. I mean, they are just eating their competitors' lunch, clearly taking market share. So if sales look this good, what's the actual problem? Well, the problem, at least for Wall Street's short-term mindset, wasn't in the sales numbers for the quarter. No. It was buried in the company's guidance for the full year, and more importantly, the reasons why they were changing that guidance. You see, management made a very deliberate choice here. They lowered their full-year EPS forecast, not because sales are weak, but because they decided to hit the gas on strategic investments. They're spending more, and they're spending it sooner, on stuff like factory automation and building new capacity. Of course, that means higher borrowing costs and higher depreciation, which hits that short-term earnings number directly. The CFO, Bill Kelly, he laid it out really clearly on the call. The company's EPS guidance got cut by about 3 cents. He said about half of that hit was from higher interest costs on their debt, and the other half was from higher D&A. That's just the accounting cost of all their new equipment. And it all happened because they intentionally front-loaded their spending, pushing 70% of the entire year's budget into the first 6 months. And this is the key message management was trying to send. They signaled that this financial pressure is temporary. The CFO went on record saying they are confident 2025 will be the peak for capital spending. They're framing this as short-term pain for long-term gain, building a leaner, meaner, more profitable company for the future. But the market can have a very short fuse. Instead of focusing on that long-term story, it zoomed right in on 2 key metrics that, to be fair, do signal some near-term risk. The first one is leverage. The company's net debt is sitting at 4.1 times its adjusted earnings. Now, a number that high just makes investors nervous. It means any little hiccup in profits makes it that much harder to service all that debt. But if you only focus on the debt and the guidance cut, you are missing an absolutely incredible operational story here. I mean, this company is winning market share hand over fist. Their household penetration is now up to 50%, and their core Power 4 brands are just firing on all cylinders. And this is so key to understanding the real health of the business. Their core segment, branded salty snacks, makes up almost 90% of their sales, and it's growing organically at a super robust 5.4%. This is the powerful engine that's driving the whole company forward. So how do we square this? How do we reconcile management's long-term strategy with the market's very real short-term fears? Well, that brings us to the next call, our take on what comes next. The entire investment thesis here really hinges on one thing, a potential narrative shift. See, right now the story the market is telling itself is EPS is constrained by all this investment. The opportunity comes when that story pivots to, wow, this is a margin compounding machine with huge distribution tailwinds. We think the market is getting hung up on these temporary headwinds and is completely mispricing the long-term opportunity. So with that in mind, how could you play this? Here's our first trade idea. We're calling it the productivity play. This is a medium-term idea, and it's all based on the market eventually waking up and realizing the benefits of these strategic investments. So the action here is to buy the stock, go long the equity, while at the same time selling some out of the money puts. What that does is it brings in cash right away, which lowers your cost basis. It's a way to get paid to be patient while you wait for the thesis to play out. And the catalyst we're watching for is the Q4 earnings call, when management should finally be able to show some real, hard proof of savings from all this spending. Okay, our second idea is a bit more aggressive. We're calling this one the bolder breakout. This is a play on the idea that the market is seriously underestimating the growth potential of one of their key power brands. For this one, the action would be a long call spread. Now, this is a more targeted option strategy that lets you bet on the stock going up, but with a limited and defined risk. The thesis is that Wall Street just isn't pricing in the massive runway ahead for the Boulder Canyon brand. The catalyst here is when Boulder Canyon proves it can become a multi-$100 million brand on its own, which is something management seems incredibly confident about. So let's put it all together. What we see here is a major disconnect between the short-term fears of the market and the long-term fundamental improvements in the business. And for that reason, we are initiating our rating on Utz Brands at Outperform. As always, this is not financial advice. This explainer is for informational purposes only, and we strongly encourage everyone to do their own research and their own due diligence.